Hi, my name is Richard Clark, and I'm the Director of Business Development here at Jensen Investment Management. We appreciate you joining us today. I'll be the moderator for this webinar that we're calling Ask a PM. This is the second in a series of webinars where we're taking questions submitted from investors and we're putting them to members of the Jensen investment team. We received a lot of great feedback from our first Ask a PM webinar and a lot of new questions, so we're excited to be here again today for another round. So before we jump into the questions, let's get to know the members of the investment team on the call today. I think the best way to do this is to go around the horn here and let the guys introduce themselves and maybe tell you a little bit about their role on the team. So with that, Eric, do you want to lead us off?
Sure, Rich, and thank you. I just started my 21st year in the business here at Jensen Investment Management. Currently serving as one of the portfolio managers and chief investment officer, helping to provide oversight and guidance over all of our strategies, but predominantly spending most of my time with the quality growth strategy that I know we're going to talk about today.
Great. Alan?
Yeah, thanks, Rich. I'm Alan Bond. I joined Jensen in February of 2007. My current role is as a portfolio manager on both the quality growth product, which will be the focus of today's call, also on our global strategy. I'm also head of research in a role in which I'm tasked with kind of administering the research effort, making sure that we stay organized and efficient and on track from a research standpoint across all three products. And then I'm an analyst. I cover individual stocks across all three of our portfolios, the quality growth, quality value, and quality global portfolios.
Great. You guys ready for some questions?
Yep.
All right. Eric, we've got you up for the first one. How can competitive advantages help companies manage through times of uncertainty?
I think that's a great question, and clearly one that's rather timely given the current environment we're in. You know, competitive advantages have frankly always been at the forefront of what we look for when we're thinking about the types of businesses that we want to put into our portfolios. We really, as you mentioned, the idea of quality investing. For us, competitive advantages and quality very much go hand in hand. You think of competitive advantages as foundations that help businesses be successful. Now that in and of themselves, those advantages aren't going to be ultimately what makes the business successful. You need to have management teams that drive strategy based on those advantages. You need to have outcomes that are favorable from the standpoint of cash flow generation because of the business operations. But the competitive advantage profile itself is what really starts the process, if you will. And when you think about more challenging times, volatility because of all the things we're facing today, interest rates that are much higher than they used to be, inflation that's much higher than it has been for some time. What competitive advantages do and what quality businesses can do because of those advantages is really have the ability to navigate those choppier waters that we're facing with perhaps a lot more consistency or persistency to their business and their ability to really drive their business in times like that. Whereas companies that don't have competitive advantage, they're going to struggle a bit more when times get tough. We've not been in a period of, or I should say, fortunately, we've not been in a period like that for quite some time. But now that we are, when you think about, for instance, an element called pricing power, competitive advantage allows companies to have pricing power because they're market leaders. They are companies that control their destiny to a greater extent. And by being able to control your destiny, you have, we think, a better opportunity to be more resilient in challenging circumstances. And I think that's one of the great things about a highly competitive advantaged company is that they're much better at controlling their destiny and therefore less likely to be risky from an investment perspective, which is ultimately what we're trying to do, is find great investments that will help create wealth for our clients and our employees.
And looking across all three of our strategies, are there specific competitive advantages that kind of stand out with these quality companies?
They're going to be different depending upon the industry or the sector that these companies are in, right? I mean, if you think about a consumer staple business, the competitive advantages are probably going to be mostly centered around the brand loyalty that they're able to generate when someone, goes to a grocery store to pick up a particular item. They may first and foremost think of a particular brand that they're familiar with because of the investment the company has made into making sure the product is a quality product and that they produced, strong advertising or support for the brand. When you talk about healthcare, healthcare is probably driven more by things like patent protection, where because of the technology and the research and development those companies have done, they're able to protect that, which then becomes an advantage that they can then utilize in the marketplace to drive value. When you talk about technology businesses, you may get into things like the network effect. In other words, the more people utilizing a product, you create a network of individuals that creates a powerful opportunity, or maybe simply economies of scale. In other words, think about a software company producing software. The first piece of that software may be the most expensive component or piece of it, but as you do that millions and millions of times, the economies of scale become very much in your favor. So the competitive advantages will be very different by sector. But in every case, what I think you'll find is something that has been germane to that business. And when we think about it, we want to see that it's been durable over time. And based on our research that the six of us do on the quality growth strategy, we want to make sure that it's then going to be sustainable into the future. And that really is a key component, regardless of what type of advantage they have.
That's great. Thanks, Eric. All right, Alan, I've got a real softball question here for you. From a global, macroeconomic, or political perspective, are you looking for anything in particular to calm markets in 23?
Yeah, that's a good question. And I think we should preface the answer by stating that, we spend most of our time here at Jensen looking at businesses individually and then how they're priced as stocks. And so our portfolio construction process is very much bottoms up. So it's business by business, stock by stock. So, good question. Not something that we proclaim a lot of expertise about in terms of global macroeconomic, environment. That being said, there was really maybe 2 or 3 items that were really rattling markets last year. So last year we had a large decline in the market, largest decline in the market I think we'd had in 13 or 14 years. And it was really a function of concerns about inflation, in particular uncertainty about the magnitude and the duration of high inflation, and about the Fed's response to that higher inflation, in particular how monetary policy actions are going to impact or be dictated by inflation, and how hawkish the Fed would have to go. And that was uncertainty, and it was new uncertainty. The market does not like uncertainty, and I think it rattled markets and resulted in a weaker year for capital markets returns. As we roll forward into 23, it's hard to know exactly what will calm markets. I think one thing that's important to remember is that, or important to highlight, is that the questions that we're asking right now are a little bit different, right? We've seen evidence that inflationary pressures are easing here in the U.S. Some of the supply chain issues that we're holding back on creating cost inflations, those have ebbed a little bit. We're still seeing evidence of wage inflation, but we're starting to see signals from the market that maybe the Fed's gone far enough. And I think the question that we're going to be thinking about as investors this year is the Fed going to keep going, and are they going to go too far, right? And the answer to that question is going to determine whether or not the markets are calm or the markets are fearful, in addition to a lot of other things, right? I think if we sat here this time last year, I'm not sure we would have predicted that Russia would invade Ukraine, and we'd have more geopolitical uncertainty than we've had in a long time, right? So the big picture things we talk about, that's kind of the known knowns, but we know there's probably a lot of known unknowns that can dictate the market environment from an economic or geopolitical perspective, as we work our way through the years. What does that mean for Jensen? Uncertainty makes quality investing that much more important, because what we are trying to do from an investment standpoint is control what we can control, right? We cannot control geopolitics. We cannot control the global economy. We can control the types of businesses that we invest in. And we can invest in businesses that are high quality, that benefit from competitive advantages, and have demonstrated the ability to earn high and consistent business returns over time. Those are things we can control. We can control the price we pay for those businesses. We can build valuation models, making sure that we are investing in these businesses with a margin of safety to help mitigate long-term pricing risk. We can control the amount of risk or volatility that we take, because we can measure volatility and we can determine how much is adequate, how much makes sense within a quality strategy, and manage volatility risk. So by managing the quality of the businesses, the price we pay, and the volatility that we're willing to weather within the strategy, there is a lot that's under our control. And if we're patient and we don't try to fight the market, but we kind of take what the market gives us over time, we think that's a winning strategy, and we think it's a strategy that can be successful whether or not the global geopolitical climate or the global economic climate is calm or is jittery or whatever.
Rich, can I maybe add something or think about that differently? That same question.
Yeah, go ahead.
So I almost think, perhaps, you got to the idea of what can calm markets. I almost think of it in two sort of perspectives. One is what can calm markets from a Jensen perspective versus what might calm markets more generally, so the general investor. And I think they're very different outcomes because, as Alan mentioned, I think our investors, our clients, frankly, can be a bit more calm. And part of that is because of the deep due diligence we do in our businesses, the competitive advantage profiles they have. We know what we own, therefore they can be comfortable that they know what they own. And that can be calming in and of itself. From the general market perspective, I think the one thing that probably might help to calm markets, and this is one thing we don't have right now, which is why they haven't been as calm, is that we don't have any real certainty around some of these issues, right? If there were certainty around, well, how long are interest rates going to keep going up? How long is inflation going to stay at elevated levels? That will be the thing that potentially could create a calming effect for markets generally. But because that's not something you can actually bank on necessarily, that's why we think a bit differently and say, no. How can we understand what our businesses are doing? What can we do to make sure that we're doing the most that we can to help control our outcomes from an investment perspective so that we don't have to rely upon other devices that are designed to help, quote, calm markets, as you suggested.
So I think this is a good follow-up question, Alan. I'm going to go ahead and give it to you. And I think you guys have both touched on this a bit. But which industries, companies do you think will do well in the current environment?
Yeah, I think that's a great question. And, I would just say that our focus is on not only understanding what companies are going to do well currently, but what companies we think can do well sustainably over the long term, right? So we have a portfolio where average turnover, our average holding period is 7 to 8 years. So I think it's really important to to create that context for how we think about the short term. In the short term, Eric talked about this. I mentioned that inflationary pressures have kind of ebbed, and that's true. Inflation is still high, and it's still higher than the Fed would like, and it's still higher than I think a lot of us would like when we go to the grocery store or go to the gas station, right? So companies that can do well right now are companies with pricing power. And Eric talked about the importance of competitive advantages. Competitive advantages in a lot of cases are what allow a company to have pricing power. So as we are thinking through building our portfolio and identifying research candidates, pricing power is the one topic that we've been coming back to again and again when we're going over company earnings reports or we're looking at a new business, because we think that's really going to be the key for companies to not only offset costs, but continue to grow, continue to create business value despite higher cost inflation. Because if you can pass costs along, cost increases along, you can still grow, you can still be profitable, you can still generate strong business returns. And I think, Eric used the phrase "know what you own," and in environments like this where there's uncertainty and there are macro factors like cost inflation or like wage inflation, it's really, really important to know what you own. It's not an environment where trying to take broad risk exposures is going to help, because the risk is at the company level. It's at the business level. And to understand how a business can mitigate those risks, it's really important to understand where they derive pricing power. Pricing power can come from a business model where companies have contractual revenue with price escalators built into those contracts, right? That's a great example of pricing power. Pricing power can come from a business that captures, that generates, that monetizes based on a percentage of total spending. So as spending goes up, their revenue goes up along with it, right? And so understanding those nuances, understanding how businesses make money and how they can increase prices is really, really critical when you're in an environment where there still is a lot of cost uncertainty.
Thanks, Alan. All right, Eric, you're up. And speaking of risks that we have no control over, this is a good question to follow up on that. How will consumer behavior change in 2023, and what impact might that have on companies in the growth portfolio?
So you're actually asking me to predict consumer behavior? Look, I think we've already seen that there's going to be some impact on consumer behavior. What's one of the most challenging aspects of what's happening right now is that the idea of what should happen with consumer behavior is in some respects not happening universally. I think you could talk about it from the standpoint that, here domestically and maybe globally, but certainly domestically, we have, frankly, a bit of a bifurcated economy. There's a lot of folks that are talking about recession and the likelihood of a recession, and that would clearly have an impact on consumer behavior. But yet, at the same time, this is where I would say that there's sort of two elements, or two areas within the economy. Higher income individuals maybe aren't really feeling much in the way of recessionary environments. You see and hear a lot about how consumer spending remains very robust. Airplanes are full again, hotels are full, restaurants are full, sort of back to, if not exceeding, pre-pandemic levels. And yet, on the other side of the equation, because of higher inflation, because of higher interest rates, the housing market is much more constricted. Lower income households are struggling. It's a bigger percentage of their wealth or their income is going to pay higher grocery prices, pay higher gas prices, as Alan alluded to earlier. And so, I think there's going to be different ways that consumer behavior will change. Now, step back from that and think about it from, okay, so now what does that mean for the companies in which we invest in our quality growth strategy? Those are all parts of the mosaic that we have to understand. And so a company that is maybe, less susceptible to consumer trends, but maybe more about business spending, we might not be quite as concerned about some of that recessionary component, although we have to think about what it could mean to the business itself in terms of if they need to cut their costs or do something drastic from that perspective. A company that's more consumer facing, like a consumer staple companies that we were talking about earlier in terms of brand as a competitive advantage, there could be some pullback, and we'd have to incorporate that then into our projections of what we think about in terms of what's going to happen from a discounted cash flow analysis. And so ultimately that ripples through into, if we think about slower growth potentially because of changing consumer behavior, what does that mean in terms of how affordable that stock looks in the current environment based on what we think it's worth if our projections get slower or smaller? So it's part of the mosaic. There's no question about it. Consumer behavior, look, consumer spending is 2/3 of U.S. Gross domestic product in terms of economic growth. So it's a really important element, but it's not quite as straightforward as just saying, well, consumer behavior goes negative, therefore growth goes negative, or something like that. It really, you have to think about it from sort of multiple perspectives. I do think the trends would suggest, and I think we would concur with this, that the likelihood for growth slowing is high. In other words, we are entering or have entered into a period of sort of a slower growth environment. Part of that's because of the consumer behavior that's changing. Part of that's because of the other elements that are changing. And so therefore, if we're entering a slow growth environment, we think that the more consistent business models will be the ones that ultimately should gain more recognition because they're less volatile and less risky when you're thinking about where you want to invest your money as an individual or as a corporation or as a foundation.
Alan, let's stay on that topic of trends that Eric brought up. What market or sector trends are most interesting, potentially impactful in healthcare right now?
Yeah, well, that's especially important for us because healthcare is a sector where we have a meaningful weighting in our portfolio and have had for quite some time. And there's a good reason for that. Healthcare is a sector where we find individual businesses that have competitive advantages. And that's really the key determinant of whether or not a company is going to be a good fit for our strategy is if a company has a sustainable competitive advantage. In healthcare, we see competitive advantage around brand strength, around global distribution and infrastructure. We see competitive advantage around technological differentiation. And these are really the building blocks for the types of businesses that we want to invest in within the healthcare sector. In terms of trends, there's short-term trends and there's long-term trends, and in a lot of ways they're kind of the same right now. One of the big trends is the aging of the population globally in developed markets. And as the population ages, generally speaking, the usage of healthcare products goes up. That means higher demand for healthcare products, and generally that is a good thing for healthcare companies, especially the ones that we own that we believe are well positioned for this trend. The other big trend is that healthcare infrastructure is being built and grown globally. So developing markets where in the past maybe healthcare infrastructure wasn't great, we're seeing growth there, and as that happens, that increases the demand for all types of healthcare products, and we think that's a good long-term growth driver for the healthcare companies as well. In the current environment, what we are looking for is healthcare companies that can demonstrate pricing power. Just like we're looking at across all industries, healthcare is not immune to some of the cost inflation pressures that we're seeing, and so we've gravitated towards companies that demonstrate they can get price when they need it, and that's really one of the key trends that we're going to continue to watch as we get into 2023.
All right, sticking with this topic of healthcare, how are Jensen's healthcare companies pivoting to stay competitive in a post-COVID world?
Yeah, I guess what I would say, or I'd counter that a little bit in saying that I'm not sure that there needs to be a pivot. That I think the healthcare companies that we own were relevant before COVID, they were relevant during COVID, and we're confident they're going to be relevant after COVID. We have seen the impacts of COVID. So in the early stages when everything shut down, that was a negative for companies that depend on the regular utilization of the healthcare system because it lowered the demand for their products. The flip side of that is those companies now benefit as there's pent-up demand for these products. And we invest in businesses that have staying power and have stable and growing market shares. There may have been a lull in demand, but the overall market landscape didn't change during COVID. And now that things have recovered, we're seeing heightened demand as a result of pent-up demand that happened during the pandemic. On the other side of the equation, we own United Healthcare, which is a managed care stock. They actually benefited during COVID due to lower healthcare utilization. But because of their pricing power, because of their reach within the domestic healthcare system, they've been able to continue to grow, and we think will continue to grow even though healthcare demand has come back, and they can price that appropriately. So we think that what we're trying to do is invest in across sectors and businesses with staying power. Healthcare is no different, and so if there is a pivot, it's a subtle pivot, but it's really more about continuing to do what they do and what made those businesses strong for a long time.
Alan, do you have an example of maybe a company we own that is going to benefit from sort of normal utilization of healthcare?
Yeah, I think the most obvious one in our portfolio is Stryker. Stryker does medical devices and healthcare and surgical equipment are their primary businesses, and their business was affected negatively when the shutdowns occurred in the early stages of the pandemic because their products are only used when hospitals are open and surgeons are doing surgery. So when we looked at that at the time, we thought, okay, this is a short-term issue. We recognized that, but long-term, it's a positive because the procedures that they support can be put off, they can be delayed, but they usually can't be delayed forever. And so as the healthcare system has reopened, these procedures are coming back. The kind of good thing, bad thing is there's not enough healthcare capacity, even with the healthcare system open, to do all this pent-up demand, all these pent-up procedures at once. But it creates a long tail. And so we think that it's going to be a growth driver looking forward for Stryker and some of their other companies as healthcare catches up with that pent-up demand.
Great. Thanks. All right, Eric. Obviously, the tech sector got rocked last year. Tech is one of our largest sectors. How are we thinking about tech investing going forward?
It's a good question, and you're right. It's one of our largest sectors. I think about a third of the portfolio actually is in the information technology sector. I think there's a couple of different elements to talk about here. First of all, the tech sector last year was hit hard from a stock price perspective. Okay, does that mean that the businesses are weaker than they were a year ago as we headed into 2022? No, I think what we saw was a reset in stock prices and valuations, which had nothing to do with the businesses themselves, or at least not directly. It was an indirect effect because we saw rising interest rates. And as interest rates rise, you think about what a company is worth, the very work we do from a valuation perspective. We look at all the future free cash flows that we think that company can produce, and then we discount those back to current day based on a discount rate. And as the discount rate rises, the value of all of those future free cash flows inevitably comes down. And as a result of higher interest rates, therefore higher discount rates, there was a reset of stock prices for technology businesses because, by and large, they are faster growing companies than, say, more GDP-like companies like consumer staples or healthcare. Now, that said, was the reset, appropriate? In our case, or in our perspective, arguably, in some cases, we would say no. It may have been too overdone. And so it's actually created an environment where there may be some opportunities. We think there are some opportunities from a valuation perspective in some of our technology companies because the broad brush that happened to all of the technology sector maybe was a bit much last year. I think a lot of it was focused on companies where their growth in the future was maybe the most important element of the profile of the business. And perhaps they weren't even really generating much in the way of cash flow today, or even had existing cash at their disposal as a defense against slower growth in the future. To call all of those companies or to paint all of those companies the same way in terms of valuation reset felt a little overdone to us, quite frankly. The more established businesses with truly strong competitive advantages, where they've already generated tremendous cash at their disposal as a ballast against the difficulties they were facing, currently producing cash in the world that we live in, and have good growth in the future, that's a very different profile than a company that isn't necessarily making any money now, but has some sort of momentum growth built into its future valuation. So that's area one, or concept one. The other side of it, I think, too, and this is something I think that's an element across of the entire portfolio. We may look concentrated at the sector level. I mentioned a third of our portfolio being in the technology sector. Part of that is a natural consequence of the ROE screen that we utilize to select companies. It naturally creates certain sectors where we find competitive advantages in greater numbers, in greater businesses. And it also creates sectors where it's much more challenging for us to find companies that can qualify for our discipline. So therefore, we don't have energy, we don't have utilities, we have a limited exposure to financials, and that creates some of these natural concentrations as well. However, if you take the sectors and move it down to the industry level, you find that the concentration that might get to the heart of your question around technology changes, because we have companies that can be very solid businesses because technology is the advantage that they go to market with. It's what gives them economies of scale or the ability to reduce cost per customer, but it isn't necessarily what drives their business itself. A couple of examples where you could think about this are MasterCard. MasterCard has a huge technology advantage over other credit card providers. They're one of the big two. But what really drives MasterCard's business on a day in and day out basis is the amount of money people are spending. Financial transactions, which really doesn't have much to do with technology per se. And as consumer spending, as we talked about earlier, stays higher, MasterCard will see more throughput. As global travel has opened up, MasterCard sees more cross-border transactions taking place. That drives additional value through the business. And yet, MasterCard was hit very hard last year from a technology perspective because it's in the same sector as these other businesses like a Microsoft or an Apple. Another one would be ADP. ADP is considered technology, but ADP is a human capital management company doing a lot of payroll processing, benefits processing, tax processing. And so it's about employees and the number of people that are working, creating an outsourced solution for their large company customers. Technology, again, is the advantage. Should that business go down by the same amount as, say, a high-flying tech company like an Amazon or a Facebook? It's hard to see how that broad brush would be painted the same for all technology. What I would say is, as we look here at the early parts of 2023 in a new year, we think there are some attractive opportunities, certainly across the portfolio, and in many cases, specifically within the technology sector, because while some level of reset was necessary last year because of rising interest rates, therefore rising discount rates, in some cases it may have also been overdone, creating opportunities for active, high conviction managers that really understand their companies to find valuation opportunities in what generally would have been thought of as a much more frustrating market.
All right. Thanks, Eric. All right, last question. This is a question for both you guys. I think I already know the answer to this, but I'm going to ask it anyway. Maybe Alan, if you want to start. Eric, you also chime in here. Is Jensen planning on making any portfolio changes next year based on the current market environment?
Okay. Well, I would answer that in saying that the answer is yes. I would anticipate that we make portfolio changes in 2023. And yes, it will be based on the market environment. But the way we make decisions about the portfolio is going back to what I talked about. It's about our confidence in a business, our confidence in the valuation and total return opportunity in a stock, and then our view on risk. And when we make decisions, we do so as a team. It's a team-based management system, and it's based on each team member's individual input. On average, we make about 2 to 3 wholesale changes in the portfolio for a year. So that could be a complete sale, that could be a complete purchase of a new name. And so because of that, I'm confident we will make changes. I'm confident it will be because of the market environment, because it goes back to what I was talking about earlier. Our goal as long-term investors is to be patient and to wait until we think the market has given us an opportunity either to exit a position that might be fully valued, or to enter a position where we think we're able to identify or able to own a high quality business with an adequate margin of safety. And so what we try to do is we try to find times when our long-term view on a business or on a stock is disconnected from the short term. And when we think that we can find these opportunities, that's often when we do make trades. And we do so, though, within the context of a very low turnover strategy and a very low turnover portfolio. Like I mentioned, on average, we hold stocks 7 to 8 years. We've held some much longer than that. So I'm not anticipating that we have a big churning of the portfolio, if you will, in 2023. But I do foresee us making some changes. It's just hard to know exactly what that's going to be and when it happens.
Yeah, I think, Rich, the other thing I would say, maybe Alan captured it quite well, but what I would say is, change comes in many forms, right? It could be everything from wholesale changes where we add a completely brand new company, sell one of our existing businesses, but it can also be things where, as short-term issues or opportunities arise, even though we are long-term investors, of course, we need to consider those short-term opportunities. And maybe we add $10 million to a position, 50 basis points, 100 basis points, or we take away 50 basis points or 100 basis points. Those will be sort of shorter term in terms of the length of the decision or what's causing it, but it's driven from a long-term perspective, in that maybe it's an opportunity for us to get some additional shares in a particular business we really like fundamentally at a cheaper price because the market is dislocated a little bit to the downside for some reason, some unknown reason in the short term. Those kinds of changes, frankly, they should be happening. Now the other side of this, we would say, and we certainly have long said, look, we're trying to build a portfolio of the 25 to 30 best companies, best combinations of fundamental strength and valuation opportunity. And if the companies do what we expect or exceed even our expectations and don't get overpriced in the market, we won't. Why would we sell them? Now, that would tell you that we're not going to make any changes as long as they meet or beat our expectations and don't get overpriced. But as we well know, that's not the way the world works. Something is always changing. Our job is to pay attention to what's going on, discuss it, and potentially make changes as we see are needed or desired. But they could be very small changes as well as sort of larger changes. The grander scale to this, though, should be, as Alan said, lower turnover than what people generally experience, because there shouldn't be a reason for us to have to change our business lineup or our portfolio lineup as often or as frequently, because we really are trying to invest in the very best types of businesses that have the very types of characteristics that allow them to be long-term holdings inside of a long-term strategy that can be more consistent over time. We will always make changes, but we'll do it with an eye towards the long term while taking advantage potentially of things that might happen in the short term.
All right. Well, thank you for joining us today. We appreciate your continued interest in what we do here at Jensen. If you have comments, if you have feedback, would like to submit a question for a future Ask a PM webinar, or you would like to schedule some time to see if one of our quality focused strategies makes sense for your practice, please reach out to me at our website, jenseninvestment.com. So with that, we'll wrap this up, and we wish you the best of luck in 2023.